Eileen Riley from Loomis Sayles. Welcome to the Growth Symposium.
Thank you very much. I'm happy to be here.
Can you walk us through the universe of investments for your global equity strategy?
Yeah, the global equity strategy is an unconstrained global portfolio. So the universe of investments is actually the market, so to speak. We do have a market cap limit, 2 billion. So it's anything above that. Sounds like a really big universe. How do you go from there to a very concentrated portfolio? And that's the way we constrain the universe, not by artificial third-party metrics or definitions of growth or value. The way we constrain our universe is looking for quality businesses that have the ability to grow their intrinsic value over time. And then, of course, we obviously will constrain it by a valuation framework.
And what's one of the most persistent traits of those high-quality businesses?
Yeah, I think it's one of the traits you see if you look over a long period of time. It really is free cash flow generation. And the ability for a business to consistently generate that cash flow over time. Of course, there's other aspects of the business, and when you think about that, comes back to how do we define quality. But most important is the outcome of all of those metrics of quality results in a business that generates free cash flow and deploys that capital effectively.
Outside of market cap, are there any other limits or restrictions you have on the holdings?
Yeah, so market cap, as you said, it's $2 billion and above, and that's just from a liquidity perspective. That's why we have that in place. From a geographic perspective, we don't have constraints. And the reason for that is the idea of this portfolio, the goal of this portfolio is to deliver excess return over time. And to do so, we think you need a concentrated portfolio of global equities. So, of course, we're seeking diversification, but we don't want diversification to provide a governor or limit on the way we think about populating a portfolio with best ideas.
Does that mean you'd have a larger tracking error?
So our tracking error isn't something we target. It's really an outcome. And if you look over a 10-year basis, it's varied, but it's averaged about 5%.
And how have you repositioned the portfolio or adjusted the portfolio in light of rising interest rates, rising bond yields, and increased inflation?
Yeah, so the real question there is, how does the macro impact our ability to construct a portfolio from the bottom up? And I think that's an important distinction in how we're constructing this portfolio. It absolutely is from the bottom up. So you're not going to see us say, here's a macro trend, we're going to chase it with the following stocks. What you will see us say is we recognize that these are the influences from a top down that are happening in the economy and ultimately in an individual business. And then we take that and think about how do we construct our forecasts, our financial modeling to appropriately then incorporate that out into the portfolio.
And you've talked in the past about volatility offering great entry points. Do you see 2023 as a lot of opportunities emerging?
Yeah, so from our perspective, absolutely. Volatility, while at times can be uncomfortable for some investors, that is what creates opportunity. It's difficult to predict exactly when a significant market event will happen, and particularly thinking about volatility from the downside, a market drawdown will happen. But what our job is and what we think our role is to be ready and be prepared. And the way that we do that is through populating our tracking lists, our research process, so that we have businesses that we are confident in the quality, we're confident in the intrinsic value growth, and we're looking for that opportunity so that when it happens, we can move quickly.
And what's one of the most compelling ideas in the portfolio at the moment?
Yes, so when you own a concentrated portfolio, right now we have 35 holdings, you really have to like all of them. And so it's hard for me always to pick just one. So I'll start by saying that. But to give you just one, just to get an idea into discussion, I would talk about Danaher. That's a US-based healthcare business. They are in bioprocessing, testing and measurement, and they actually have business environmental and applied solutions that they'll be spinning out. This is an incredible business in terms of their ability to execute and their ability to generate free cash flow. One of the things that we like about the business is the market structure, and that in terms of the market and the underlying secular growth behind testing and bioprocessing. The other thing we like about the business is their track record on capital allocation, and specifically actually M&A. And if you look at the balance sheet now, they've reached pretty close to the low end of the targeted range for this management team. And so we think that, I can't forecast an exact timing, but we think that they're going to be looking to leverage that balance sheet towards future M&A at some point in the coming future.
Eileen Riley, thank you.
Thank you.